Hello, this is Mike Swanson. I run the website wallstreetwindow.com. And the odds are that you're watching this video because you got an email from me telling you that it's up. Now, I want to talk today with you about the Ukraine war and impact on the financial markets and what sectors of the market are actually going up in a sustainable way. You know, in January, we saw the NASDAQ take a hit. It was the biggest January drop in the NASDAQ ever. And then we had a rebound that faded by mid-February, and a lot of stocks have gone lower ever since. But some stocks are breaking away from that market volatility and going into bull markets of their own. And that's what I want to show you, a scan I did before doing this video with the top performing sectors of the US stock market. But I haven't said much about the situation in Ukraine, and I want to make a few points about it and then about investing. But one of the reasons I haven't is because I don't believe anyone can really predict how it's exactly going to unfold, how long the war will last, and what all the implications of it are going to be. I want to talk about one of the implications in this video with you that will kind of underscore this point. But at the same time, I also feel that we are being absolutely bombarded by a lot of propaganda being created on all sides of the conflict that is designed to give you an emotional reaction to the events. In some ways, that is to draw you into them so you want to keep watching and finding out more of what's going on. But when it comes to investing in trading, you've got to not really get caught up emotionally in events. You've got to be clear thinking of what's going on. In a situation like this, I think that suggests stepping back a little bit and not trying to assume that you know everything going on with really what is a limited amount of information. So one of the narratives, I'll just say, that's in the mainstream US media since the wars began is that it's not going very well for Russia. Now, that may have some truth to it, but I've seen this wildly exaggerated. So, for example, after the war started, I did not turn on any US news at all until about a week later. No, Sunday, the war, I turned on the TV last Sunday. And immediately I saw a person on television say that the war was looking like a defeat for Russia because everyone, this is what he said, that everyone thought that Ukraine would surrender within 6 to 10 hours. Now, that's unrealistic. I don't know anyone who thought that. And that type of talk has been really prevalent in US media, that this is just a huge defeat, it's not going well. And frankly, I don't, their expectations of how quickly Ukraine was going to be defeated, very unrealistic. And now things are unfolding in a way that, it looks like it's going to continue on for quite some time, possibly. So that's just one example of what I consider to be propaganda, where things are exaggerated. There may be some kernel of truth to it, but they're exaggerated. And these, I'm not saying this person on the television was lying or deliberately deceiving people, but this may be the fantasy that they're caught up in believing. And likewise, in Russia, I have no doubt that the people over there are being bombarded by intense propaganda, and is people who are trying to profit and align ourselves with what is happening in the markets, we've got to be clear-sighted and clear thinking. And that's one reason I haven't said much about these events at all. Another one is that I don't think they're dramatically changing the market action as we see it so far. I mean, I'll show you some things that are dramatic, but even them, we've seen oil go up, right? But oil has been going up for months. The inflation began last year, not just when this war started. So the underlying trends that people have been in place before these events that are now intensifying. And I think that's the way to understand, for instance, the rise in commodity prices, the rise in energy prices. They may have taken place anyway over time. They're just happening a little bit more intense, a little bit more quicker in the short term. And that said, as investors and traders, the key thing to do is to stick with the large trends in the market, align yourself with them, and notice when they make mega shift changes. And I already wrote in January that I thought we were seeing a mega shift change in the commodity market, turning more bullish, and the stock market, a lot of it, not doing quite the opposite. And then I was saying this before the war even started, and I hold that opinion now. But I'm going to focus in the video in a little bit about where things are going up, where it's worth buying stocks, and it's not all commodity related. I'm going to show you some sectors not commodity related that look like they're going to continue to go up, that they have not really fallen much. And this year, they've simply paused on the charts, and they have nothing to do with commodities, though I'm very bullish on commodities, and we will talk about commodities. But to get back to how difficult it is, let me show you some stories in ways I'm dealing with the situation to try to understand what is really going on, which is very difficult in a time of war. What they say, the truth is the first casualty of war, but it's not simply that. It's war increases uncertainty and complexity. It makes it very difficult to predict how things are going to unfold. So one story I looked at this weekend was a blog post by somebody, I don't know their real name, but they go by the name Doomberg, and they kind of sum up a lot of the thoughts I've had, which I'm going to share with you in this video, the important points, I think, of what's going on. But they pointed out how natural gas prices in this chart are just skyrocketing in Europe since the war began. But look, they spiked in December, but the spike in Europe is smaller than what's going on in the United States. And this is going to have a huge impact on Europe, and we'll talk about the European markets in a few minutes. But while oil has gone up in a dramatic way, and even now in the United States, people are seeing that at the gas pump, the price of wheat and corn has also shot up dramatically, and that's going to cause food prices to go up all over the world. It's barely even began. And by the way, I'll show you in the charts, there's a connection to that and a sector in the United States doing very well right now. No one is talking about, I haven't talked about yet at all. But one of the things I've been doing is trying to look at news sources outside of the United States and in Europe in particular, because Europe is the central drive. The European reaction to the Russian invasion, I believe, is driving the world reaction to events. So as the war began, I started to look at sources in Europe to try to get an idea of what their perspective is on events. DW.com is a German news site translated into English. It's one I've been following. And, one of the big trends and questions as investors is right here. What is will war fast track the energy transition? You see those natural gas prices spiking. How is Europe going to react to that? Are they going to go back and put nuclear, a new renewed focus on nuclear energy? If so, that could help the price of uranium, the price and help uranium mining companies go up in value, because Russia is one of the biggest producers of uranium, and outside that, Rui Cameco is the biggest Western producer, and there's a few smaller ones too. But what's going to happen there? And also, there is a thought. We're being presented in the Western media, or at least the United States, that the whole world is unified against Russia, and there is a lot of reality to that. The sanctions against Russia have devastated them. The restriction on their central bank in engaging in currency transactions is devastating. But it's not clear to me what the long-term impact is on that for Russia. But the thing is that their isolation has cracks in it. And one of the cracks is right here in Israel. Israel, their prime minister went to Russia, but if you read about this trip, he flat out, and then he went to Berlin, but he flat out said that Israel is maintaining good relations with both Ukraine and Russia. So Israel is not turning its back on or away, or however you want to put it, from Russia, as the United States and Europe is. In China also is not, the Putin had a trip to China and a lot was made out of that, but China is not rescuing their central banks. It's not doing the things that it looked like they might. And one of the reasons why is because they have been taken aback by the European reaction. And I was too. So when the war began, first of all, I didn't think Putin was going to invade the entire country, but he did. And then the first day of the war, Biden, well, as the war, in the days leading up to it, there were stories saying that the sanctions could be limited, and that the U.S. and Europe may not cut off the SWIFT banking transactions because internally in the Biden administration, probably in the Treasury Department, there was debate over whether that breaking the SWIFT would actually hurt the U.S. dollar hegemony. And so there is a lot of resistance to doing so, and resistance in Germany to doing so. And England came out saying they wanted to do it. But the first day, the sanctions that were presented by Biden in the West did not include SWIFT. Within, I think it was Friday or 48 hours later, they did. And then they banished the central bank. So huge, much bigger than expected. And from what the story is that the drive to do that actually did come from Germany. So there was a big shift in, how firm the reaction was going to be. Now, it's still, and obviously the effect has been devastating. The Russian stock market is destroyed. The Russian economy is badly hurt. Inflation is exploding in Russia. But the long-term implications of all this, I think, is going to take years to play out. And one of, there's a story in the Wall Street Journal on Friday, which is the most shared story on the Wall Street Journal. That's what they show in the rankings. And someone emailed it to me also. But it's asking, what are the implications of banning the Russian central bank from using its currency reserves to prop up the ruble? Well, the story says what this has demonstrated is that currency reserves aren't really money if the people's whose currency it is says you can't use his money anymore. And it says that Russia has learned this tough lesson, and that as a result, more of Russia's money will likely shift into gold and Chinese assets. So that would be bullish for gold if that were to happen. And then it advocates that then what do you do as an investor? It says buy gold yourself. But it's not just Russia, right? If this logic is taken up by other countries, they will do the same thing. And that may threaten US dollar hegemony. So while at the moment we are seeing the power of the US dollar, perhaps the question is this peak power geopolitically for the US dollar or not? I don't know the answer. I don't know if this article is exaggerating the potential move in gold by central banks, or even the importance of this one banishment of the Russian central bank. Perhaps China is going to learn a different lesson, and that is, angering the entire world as Russia has done is not a good idea. Going to war in Taiwan or doing other things that would anger the world is not a good idea. That could be a simpler lesson to be learned from this. But the point is, I don't know. And we don't need to know the answers to all these questions to navigate the markets. What we must do is focus on the large trends of the market, adapt, adjust when they change, and look for new opportunities when they come. The real best opportunities in the market is when a bear market ends and a new bull market begins. And you can look for such opportunities all over the world. And when there is a decline or a correction, you look to see what sectors, what asset classes, even what alternative markets hold up better than the stock market averages, because those things tend to lead once the correction is over. So you always have to be looking for new opportunities to deploy more money or reposition yourself. And that's the key to long-term sustainable success in the markets. So now, one of the biggest mega shifts in the markets, which I have talked about over and over again, is the bond market. The very fact that interest rates went to zero means that they're at the lowest point ever in globally in human history, and bonds tend to trade opposite to yields. So while yields are zero, that means the bond market globally, including the United States, reached the highest value ever last year. And that means they have nowhere, there's very little, the risk to reward in buying or holding bonds is absolutely awful. Perhaps the worst thing you can even own are bonds, treasury bonds, CDs, and so forth. You can't even beat inflation on these things. So you're guaranteed to lose value of your money when you buy them. But most people remain invested, like 30 to 60% of their money parked in bonds, because that's been a good thing to do since about 1981. It no longer is. And I think the thing for, what I believe and what I'm doing is, as I have CDs come due and bonds expire, not buying new ones and looking for new opportunities. Diversification. That doesn't mean I throw everything in the S&P 500 at all. But the thing is, while we're in a mishmash when it comes to the markets of something like the 1970s inflation and the summer of 2000 peak, where the highly valued stocks that have gone up the most the past couple of years are not doing well. They have peaked. That's why things that were fads like the ARK fund are now disasters, while stocks like Facebook have blown up, Netflix have blown up, and weakness is widespread in so many popular past fads. But what's happening is the shift out of the bond market is going into hard assets. And it's not simply because of the war in Ukraine. It's this mega bond market bubble, if you want to call it that, the bear market that's only begun. So I've talked a lot about gold, own silver, but copper has broken out. Copper surged 3% last week. So it's not just gold and silver going up, but gold and silver simply are among, I believe, core things to own now as alternatives to the bond market. And I think they're going to also go up. So gold, it broke recently above the 1880 to 1900 resistance zone. And as the week of the war started, it was chopping. It would gap up and fade, gap up and fade. But last week, that pattern changed where we saw rallies into the close that is a sign of a strengthening gold and silver bull market. And Friday, we saw gold close at 1966. And mining stocks are getting a huge bid. Newmont at a new all-time high, as example, which I own. Barrick having a nice rally too. Big caps, mining stocks doing very well. And typically what happens when they start to do well a few weeks later, money starts to trickle into the smaller issues. So a lot to look forward to there. But I've got to point out that all of this is part of an underlying large shift in commodities. This is a ratio measuring the performance of the GCC commodity ETF with the S&P 500. It had been declining since 2011, meaning commodities are underperforming the stock market. That is completely shifted, and now this ratio is going up. Commodities are outperforming the stock market. As I said, we are seeing similarities to the 1970s, and this is a textbook. From 2020 till this breakout, you're seeing what I would call a stage one base, where the prices are flat after a mega downtrend, and now we're in the bull phase, and it's only begun. So this is a huge opportunity for people if they want, I believe, to make money in a bull market. This is where the bull market is. So I know, let me show you outside of commodities though, what's going on in the US stock market. I know this is harder for you to see. I'm going to load up a different window, which is the software I use to, I'm trying to. Just give me a second. It's not always easy to navigate. There. Okay. This is TC2000. I know it doesn't show up well in YouTube and so forth, so I'm going to try to zoom in. All I want to do is show you how I've ranked the sectors in it. So I'm going to rank the sectors since November. Really around Thanksgiving is when the stock market started to get more bearish. That's when the Russell 2000 broke down. And many stocks broke down in December. So we're going to rank the performance of all the sectors in the market since about Thanksgiving. And number one, oil and gas, industrial, chemicals, agriculture, chemicals, independent oil, energy, copper, grocery stores. So that's a different sector. No one's talking about Kroger. The stock of Kroger is doing great. So it's a beneficiary for what is going on, something to think about. No one's talking about. And Kroger, what would I rather buy? Would I rather buy a Square, a Tesla stock, an ARK ETF, a crypto coin, or Kroger, shares of Kroger, the grocery store. Well, I know the grocery store is not going away. I know the grocery store, it appears like it's going to benefit, from rising prices in some way or another. We got healthcare information, oil and gas, shipping stocks, interesting, gas utility companies. Utility prices can go up when there's inflation, drug wholesale, farm products, aluminum, here's gold, here's tobacco, and dairy products have shot up, cigarettes, defense companies. These are the top performing sectors since November there. And one I want to point out to you, I know how hard it is for you to see those charts, so I'm going to get out of that because it causes people to stop watching the video. And when YouTube sees that, then they stop showing the video to other people. The algorithm is very brutal in how it works. It really encourages people make YouTube videos to only give what the most number of people want to see, which is hype. And if they don't deliver the hype and tune out, then YouTube punishes you. It's very difficult. Please hit the like button, and then YouTube will know that, hey, I do actually like this stuff, and maybe it's worth other people seeing. But the REIT sector, and I do own this ETF in my retirement account, but it's doing very well, has nothing to do with commodities. But REITs can increase rental income in times of inflation and real estate prices are going up. They raise rates by 1%. It's not going to crash the housing market. This is not 2006 or 2007 because the rate of inflation is going to remain much higher than 1% or 2%. Even if it goes down to 5%, it's still higher, and that's going to help real estate prices. So REITs are still among the best things performing in the stock market. So all that said, we are in a real bear market globally. This is an ETF for Italy. It's collapsing, or it's fallen quite a bit. It was at 34 in January. Now it's at 26. It's in a crash, doing much worse than the US stock market. Germany is dumping. It was down 5% on Friday. So this is the kind of stuff going on now in the markets. They're not bullish. The averages globally, for the most part, are not bullish at all. And that's making it so if you want to really invest and make money, you got to shift into what is bullish. And Europe is not bullish. The S&P 500 is hanging on. It's below the 200-day moving average, below the 150-day moving average. The ARK ETF is in a vicious bear market. Vicious. There's no other way to put it. And there's no reason to think it's going to end. And if you believe it, just listen to what Cathie Wood has been predicting. She's been saying inflation would go away, and that's going to help her fund go up. Well, inflation, she's been saying this for a year, and inflation has only accelerated. So her predictions have been wrong, and her fund has been going down. If she was wrong a year ago, why would one think she's right now? The whole world is going against what she said, or the world events. So get out of that if you're in it. That's what I would do, at least. So you've seen what's bullish: commodities, gold, energy stocks, of course, grocery stores, and REITs. But most investors aren't in these things at all. That's what you want to do. You want to get in trends early, not when everyone is in them. So if you look at Robinhood, in the top 100 most owned stocks on here, you will see that Tesla's number one, Apple, AMC, Ford, Sundial, Microsoft, Amazon, Meta, which is crashing, airlines, Snap, Plug Power, GoPro, Carnival, Bank of America, Delta, GameStop, Coinbase. Notice I haven't mentioned one grocery store. I haven't mentioned one mining stock. I haven't mentioned one energy company. I haven't mentioned one REIT. They're not in them. The masses are ignoring what's going up, still playing what was popular a year ago. So they're not in these new bull markets at all. And common sense tells you you want to be in early before the masses are in. Uber, I still have not gotten to an energy stock, a gold stock, anything that is really bullish on this list. And I'm going down. Marathon Oil, finally one energy stock on the list. Marathon Oil, Exxon, that's two. And it's towards the end. Two energy stocks, no mining stocks, no REITs, two energy stocks, and they're the biggest ones. Exxon's in the Dow. Marathon Oil, not in the Dow, but one of the biggest. So just two. No REITs, no grocery stores, no utility companies, none of the things going up in bull markets above their 200-day moving averages. And then Fidelity has a fascinating thing you can look at showing, this is Friday, the top buys and sells. And you can see same old plays: Tesla, AMD, Triple Qs, Microsoft, Ford, Rivian, which is in a total collapse, just falling. Lucid, crap company. Occidental Petroleum finally on the list at number 28. They just showed the top 30 buys and sells. These are the most traded or bought or sold stocks in that day. And actually, Occidental Petroleum is on the list as a sold stock. 2,200 sell orders, 1,700 buy orders. So when people do, trade an energy stock on Friday on Fidelity, they're selling instead of buying. Craziness. So people are engaging in the markets in the United States as if nothing has really changed, as if this is still 12 months ago, and all the things that have been happening have not been happening. They're 12 months behind the curve. That tells me that we're way early in these, bullish trends that I'm trying to direct your attention to in this video. So a lot of stuff going on. There are great opportunities in these markets, but few people are in them. Most people are in what are now losing situations. And why do I say it's a losing situation? Well, let's just look at one of these stocks. Let's look at Rivian here. So Rivian was one of these IPO stocks last year. It's an electric car company, and it made a new 52-week low yesterday or Friday, and it's in a bear market. What is the low on this stock? I have no idea. The company doesn't turn a profit at all. It loses money. Who knows? But people are trying to guess the bottom because it was hot for a couple of days in November. I would rather buy a REIT that, pays a dividend, makes a profit than speculate in this. But people are still in the speculative mode, not in the, hey, I got to invest in what's stable, companies that make a profit, things in the right industry, benefiting from the macro trends happening now. Inflation. Notice all these hot sectors are benefiting and will continue to benefit from inflation. REITs, companies that own rental real estate, are able to increase their rents when inflation goes on, and that's what they're going to do. Rivian can't. The costs for building its a dozen or so electric vehicles are just going to go up. Will they be able to pass that on to the consumer? Well, I don't know. They haven't successfully turned a profit yet. These speculative companies with massive debt loads are the most at risk from inflation in higher rates, because it causes the cost of them to finance that debt to only go up. Those are the sectors of the market and stocks most hurt now by what is going on. But people are still doubling down in them. Don't be like that. Don't do what everyone else is doing, because most people are suffering in this market. You don't want to do what most people are doing. You want to do what few people are doing. And that's focusing on what is now bullish in this market instead of hanging on to these fad now losing situations. So all that said, I hope this video was informative for you. If you want to see more videos, hit the subscribe button, hit the like button so YouTube will know that you like it, and then hit the bell. You hit that bell and YouTube will then send you a notification when I put the next video up. Have a good day, and we'll see what happens in the next trading session.